as I had mentioned in the last chapter when we talked about partnerships, you don't really have to do anything to form a partnership. You just go into business with somebody else and you have automatically formed a partnership. And it would require filing a partnership tax return. Now, most partnerships will do more than just that. They will like register with the state and they'll get an employer ID number and all of that stuff. But once you get together with somebody and go into business together, you just automatically form a partnership. With a corporation, it's different. You actually have to take some affirmative steps toward forming that corporation, and you do it through the state in which you are incorporated. So for Iowa, the Iowa Secretary of State's office, they handle elections in this in the state, but they also handle business formations. So if you were to go on the website for the Iowa Secretary of State, you'd see that there is a section just for businesses and business entities. And if you wanted to form a corporation, and one of the big advantages of forming a corporation is you get liability protection. So if you're a sole proprietor or a partnership and you start business, if that business gets sued for some reason or another, the person suing can go after your personal property. So it does not protect your like your home, your car, your household items, your retirement account. They can go after your personal items if you haven't set up some sort of like limited liability company, something that separates the individual from the company. With a corporation, just by its nature, it is a separate entity. It's completely separate. So if an individual sues the corporation, that individual cannot go after the personal assets of the owners of that corporation. So that's one of the big advantages of forming a corporation. There are lots of other advantages as well, but it's a legal and a tax entity. So in order to form it legally, you have to file the necessary articles of incorporation and different like bylaws. Well, bylaws aren't necessary, but they're usually recommended. Bylaws are kind of like the constitution by which the corporation operates. But in Iowa, the Secretary of State's office handles all of that paperwork, and it has to be filed. And then it's initially filed to set up a corporation, and then also on an annual or biannual basis, I can't remember which, every corporation has to file reports with the Secretary of State's office. So it's a regulated system. There's fees involved with it. It's not extraordinary. It's not extravagant, but there are fees involved with doing so. Large corporations have to use the accrual basis of accounting. So up until now, we've just been talking about using the cash basis of accounting for most of our tax transactions. We had a few little exceptions here and there. But for large corporations, they have to use the accrual basis of accounting, meaning they're going to get taxed on their receivables. Like if they have receivables on their books that they haven't collected yet, they're going to get taxed on that. What is a large corporation? If they have annual gross receipts over the last 3 years of more than $30 million, then they're considered a large corporation. If it's under that amount, then they can use the cash basis for their tax return. So that $30 million over the gross receipts, not net receipts, but gross receipts over the last 3 years. Average gross receipts over the last 3 years. The other unique thing about corporations is they can choose a different calendar year or different tax year for their filing. So far with everything that we've discussed, you don't really have a choice. You start January 1st and then you stop December 31st and then a new year starts again. And that's for individuals. That's the time period, the time frame that we're looking at. That's the tax year. But for corporations, they can choose a different year. They can start their tax year July 1st and end it June 30th. They can start it October 1st and end it September 30th. They do not have to have that calendar year for their tax year. Companies will generally do that if it's the industry standard. So an example of that is a lot of retail industries they'll want the tax year to match their fiscal year. And like, for example, the retail industry, a lot of companies will start their fiscal year February 1st and end it January 31st so that it encompasses the whole holiday period in that 1 year, and it would take into account any like returns as well that would occur in January, so they can have their tax year be the same. It starts February 1st, ends January 31st. And they talk about that here. So for example, Disney has a fiscal year end of September 30th because it helps to encompass the summer, the full summer. They're not splitting up the summer into a couple of different parts. So they can also have their tax year be the same as that. The filing requirements, so corporations have to file so it's a little bit weird. If they have a fiscal year that ends on June 30th, the due date of the return is September 15th. So that's June, July, August, September 15th, 2.5 months after the end of their fiscal year. For individuals, it's 3.5 months because we end December 31st, January, February, March, April 15th. We have 3.5 months. If their fiscal year ends June 30th, then the return is due September 15th. However, if it's any other time, then it's going to be on the 15th day of the 4th month. So they have 3.5 months. So for some reason, that June 30th date is different. Corporations can file an extension. They can file a 6-month extension for the date to file if they need it. So they can get a total of 9.5 months to file their tax return. So if their fiscal year ends or their tax year ends December 31st, they could file their tax return by October 15th if they get an extension to file that. So and they give a couple of examples there. This is what the tax return looks like. So it's called an 1120. Remember, so for individuals, we file a Form 1040. For partnerships, we file a Form 1065. For corporations, we file what's called a Form 1120. And it's very similar, again, to an income statement. So this first, you'll see this looks very similar to that partnership tax return with all of our income items in the top part and then all of our expenses. There are a couple of things that are to point out. So compensation of officers has to be separated out. The IRS needs to know how much officers are being compensated. And then other types of deductions. And again, we've got a spot for any miscellaneous deductions that don't fit into any of those spots, which there would be a lot of them. And then we have our taxable income. So unlike a partnership, corporations do pay tax. So remember, for partnerships, that income flows through to the partners, and the partners are the ones that pay the income tax, but corporations pay tax at the corporate level. And like I said, that tax rate is 21%. So we arrive at taxable income to get to what our tax is. Now, there are a couple of things that we're going to be going through here that are different for corporations. So charitable contributions have some special rules for corporations, some special limits. Net operating loss deduction, actually, we have this on the individual return as well, where you just don't see it all that often. But you do see it more often for corporations. We're going to talk about what a net operating loss is and when corporations will get a deduction for that. We've got some special deductions, in particular one that's called the dividends received deduction that is particular to corporations. So it's not something that dividends received deduction is not something that partnerships get. It's not something that individuals get. It's something that only corporations get. So and this part here, this Schedule C actually pertains to that dividends received deduction. We'll go through the rules for that that particular deduction. The computation of the tax listed here, and any credits. Schedule K is just simply questions about the corporation, whether they own any other corporations or whether any other corporations own this corporation. They want information about that. Let's see. Yeah, a bunch of yes or no questions as well. And then here's our balance sheet. Again, just like with the partnership return, this Schedule L is the same. It's a balance sheet per books. So whatever you had on the financial statement for your balance sheet, that's what goes here. Again, the beginning of year and end of year. And then this M1, which we will go through in great detail, which is our reconciliation of income per books with income per the return, how we get from point A to point B with a bunch of adjusting entries. And that's essentially what the tax return looks like. Obviously, there are a lot of supplemental schedules that can be attached. So just like the 1040 is not just the 1040, there are a lot of schedules and forms behind that 1040. Same thing with the corporate return, but we're going to look at it from a real basic vantage point. Okay.